Hi everyone, it's Grant Abbott speaking, and oh my God, can you believe what happened Saturday night? I had the absolute pleasure of watching the commentators on ABC go absolutely apoplectic and virtually crying because Shorten and Bowen and all the crew didn't get the legs that everyone was expecting. And can you believe Channel 9, the news poll, predicted an exit poll that it was 2% swing, well, not 2%, in fact, I think it was 4%, 52 to 48 in favour of the Labor Party. Here's the first deal is, if you ask me, surveys are absolute rubbish. They're not even worth the time. And hopefully, after Brexit, after obviously the last election where Hillary was supposed to win 1,000 to 1, and also this one, that no one really takes advantages of surveys anymore. But look, that's not the part here. Morrison is not exactly the Virgin Mary when it comes around to making changes to super, but he's certainly a lot better than what we would have ended up with. For all of us who are practitioners, if Labor got in, we would have made the best of what we've got. We would have had to change family trust. We'd have to tighten up a lot of our superannuation. It would have been an absolute disaster for LRBAs to go. But we have dodged a bullet, and thank you, Prime Minister Scott Morrison, for that one. You worked hard, and I think it was great because he didn't have all those waffle heads like that Nonga, Christopher Pyne down in Adelaide, and a few of the other cabinet who quite often put their foot in their mouth. It was more of a presidential-style election. He got it through, and honestly, I believe that Australians, I said last week, that let's hope he got up because Australians do like an underdog, and we've got him, and he has promised no change to the super, but, who knows what will happen there. Anyway, let's get into it. I've got lots and lots of strategies, ideas. I don't want to waffle on around, obviously, the Labor Party. Let's have a look at what we've got, what's coming up, and more importantly, how we can take full advantage of it. And I've got a whole lot of, about half a dozen really good business ideas for you to focus in on and start to specialise. Anyway, we escaped the cauldron by our fingers, but here's the deal. Once the genie's out of the bottle, it's hard to forget it wasn't out. Labor's always going to have to face its refundable franking credit demons, but there's $3 trillion in super now, so there's always going to be changes, and big changes. I don't know if many of you remember that the pension T-bar was introduced, and really no one at all put their hand up and was concerned. I mean, the fact that the T-bar, you had to drop out after 1.6, throw it back to accumulation, by its very nature actually ate into franking credits and did have an impact there on the amount of refundable franking credits were available, but no one, absolutely no one, put their hand up. And more importantly, the pension T-bar was retrospective. So there will be changes, I guarantee, over the next 10, 15, 20 years. But at least for the next 3 years, we've got a really good heads up. And my theme today for all of you is it's time to accelerate our strategies. If there's any planners on here that were looking at getting out of the industry over the next few years because you're worried about the 2024 and having to do all the exams and the bridging courses, look, just chill out. You've got like a 3-year really solid window to get some good fee-for-service income, and I'm going to cover a lot of those. So we all want to stay in. I'm right in my eyes on this. I'm going to be around for a long time. I can guarantee that, particularly with my daughters, the way they spend. But anyway, at this time, all I can say is we really need to go from broke. We escaped the dungeon, the jail, the cauldron, whatever you like to see. But now it's time to really go for broke. We are the underdogs. I mean, at the end of the day, if Labor got in, industry funds were the top dogs. We would have got smashed as SMSFs. Now it's time to go and break their back. And more importantly, grow, consolidate, and future-proof your SMSF book of clients. That means LRBAs. Yep, we've got those for another 3 years. Let's hope those snivelling banks come in, but it doesn't matter. We've got some other great providers out there who've got some really good deals, which is fantastic. Hopefully, peer-to-peer lending will get up and running. 6-member SMSFs, finally, they can't keep that in the back closet. We're supposed to start from the 1st of July 2019. Can't see that happening, but can imagine it will happen shortly, which really opens up a Pandora's box for it. For those of you who know, I had to rewrite, or actually wrote from scratch, our LightYear Docs SMSF deed and also the leading member SMSF deed. And I had in there already the 6-member and even more members if the legislation changed. So I've put in a whole lot of new stuff into these deeds. So it's a really good time for you to go down and look at your clients and reinvigorate them. Tell them they've escaped, they've dodged a bullet. Let's get into it. Leading member SMSFs are really for lineage and bloodline planning. So I'll talk about that a little bit later on. It's time to go deep into estate planning. It's great fee-for-service income. You'll find that most lawyers that I know, particularly most lawyers on the outside of SMSFs, really have got no idea, and they push everything through the estate where the Family Provisions Act jumps its head up and bang. And if you came to my ABP and TRIS session last week and you had a look at our ABP documents, our dependency declaration, which has been flying off the shelves, some great opportunities. Transferring properties into SMSFs. Can you believe it? Adelaide guys, I was doing a session. I like going and doing pop-up sessions, so watch out for me. If a pop-up session comes around, please feel free to come in and have a really good Q&A session with me. But over in Adelaide, transferring commercial property between parties, and particularly if you own a commercial property and throw it into an SMSF, then there's no stamp duty. And for me, that's crazy. I mean, there's a huge business opportunity, huge marketing, sales opportunity there for you. And getting money, and this is a big thing. Can you see down the bottom? This is what I really love. We've got 3 years. I can tell you the industry funds were going to go hard for us and try to make it. Honestly, I believe if Labor got in, we would have had a $300,000, $400,000, $500,000 minimum. We had to prove it before we set up a self-managed super fund. Now, what I would suggest, and this is where we're going, and I love the 6-member rule, the family, let's get it in. We can build sub-funds. I've built into a whole lot of my strategy sessions, sub-funds for investment strategies for younger members. But let's now start to take, particularly as we've got SuperStream from LightYear, any stamp duty transfer commercial properties in SMSF in Victoria. I think there is, but I'll leave it up to one of them. Okay, so I'm still on the same screen. So I'm still down to the same bottom. I'm pretty sure there's still stamp duty in Victoria, but we'll come back on that one. So getting younger family members in the industry super funds is absolutely crucial. So I'll trust Ashley from our team and also Mike, our COO, to handle all those questions that are coming through. So on the next page, where are we now? Well, the first thing is, because everyone dipped out, and the reason they dipped out, and I mean the front bench, is that there was changes to the parliamentary superannuation scheme. And if they didn't get out now, if they were over 55, they could access their pension, whereas they would have had to wait until age 65. That's why we saw so many jump out of government at that time. Christopher Pyne, my little Adelaide friend. So it's been good because it allows Morrison to come in, assert his authority, which I think we've all been waiting for anyway, because obviously Abbott didn't have a good run at it, Turnbull didn't have a good run at it, now they're both out, and Morrison actually got the unwinnable election up and running. So he's got a lot of authority, he can put in people he wants, and at this stage he's both super and also SMSF friendly. Broad range of Labor proposals are dead and not buried. And look, it wasn't just super. I mean, you had the NCCs going to 75. The 5-year rule was going to be dead and buried. You know, the 5-year catch-up, which starts next year from 2019 to 2020. Personal superannuation deductions were going. The extra superannuation tax was going from 250 down, the section 293, from 250 down to 200. Family trust, which I think was the worst one, we're going to be taxed at a flat rate of 30%. So it wasn't even assessable income with offsets. So, geez, there was a lot of stuff going on. But against all of that, budgets still need balancing. He's promised to get it back into balanced budget within the next 3 or 4 years. But look, the property market is down, and I think most of you guys are feeling it. When the property market goes down, Australia really feels it. So that means that the state and federal revenues are going to be impacted. State 6-member rule now is guaranteed, as I said before, 30 June. But look, I don't think it's going to happen, but it will happen. I've already upgraded, well, not upgraded, because I wrote all the deeds from scratch. I think from that saying is that it's already built into my deeds, and it can even go higher if they want. I originally proposed it should just be family members, but 6 is fine. 5-year concessional catch-up is in force. So the first year is 2019, 2020. So we remember we've got to look at our general superannuation balance of less than 500, but it is still worth it. Not necessarily for our major players in the fund, but certainly for the younger guys, and also our grandparents coming into the fund, which I'm going to be talking about. This is family and leading member funds. NCCs are at $100,000, so that stays. I'd like to see that pushed up. Certainly, the SMSF party is up and running, and Ashley's been doing a great job on that. And finally, they came back to us, and looks as though we're going to get registered. So we're going to be there to make sure we keep both sides pretty honest around it. I'd like to see the caps go up, particularly for over 50s. So I'm going to be pushing a lot harder for that one as well. From a party perspective, it's very hard to go and, in my opinion, actually go and lobby, etc., whether you're from the SMSF Association or CPAs, or you come up with some whiz-bang. It's better if you're a party, and I think there's obviously going to be votes there. And how's Clive Palmer, $70 million he spent and didn't get a brass razoo. But anyway, that's Clive, and he's got a lot of money to spend. I live up here on the Sunshine Coast, which is gorgeous, and he's decimated Coolum, but effectively, it's okay. So some 30 June strategies, ideas. First one is that we're about to hit June. And once we hit June, we can now start to use the contribution regulations, or the contributions sections under the SIS regulations, importantly, regulation 7.082. And what that essentially says that in any month, you can make a contribution into a fund, and then that amount going in doesn't have to be credited to the member's account. It can be put up into a suspense account. In the past, I've used the term, and I've actually set up contributions reserves, but some of you may have heard me go through the Commissioner's reserve ruling last year, and for that he now doesn't talk about being a contribution reserve, he calls a contribution suspense account. Now, we can either do that one of two ways. We can put it up into a suspense account. So, for example, I could I could put $50,000 in on the 1st of June or the 2nd of June or any time, and I could book in my accounts, if you're using BGL Simple Super or Class or whatever other system using Super Concepts, I can book $25,000 as a member contribution in that year. And that might be an employer or a member personal contribution, tax-deductible contribution. The other $25,000 sitting there would then be booked up into a suspense account. Now, we could do that potentially using our accounting systems, but if something goes wrong, then what we have to do is we have to adduce from those accounting systems that we actually wanted to do that. And that's a hard yard. Look, I've seen it in a couple of cases, like Irving and Dunstan, where they did the 50-50 rule, where they had to go through the accounts and see what happened. The better thing to do is obviously put up a contribution suspense account. And for that contribution suspense account, you can go to LightYear Docs, we've got that there, but it's a very valuable tool. You see, what will happen is if I go 25 and 25, so I put in 50 for an employee this year, the way it works is the whole 50 has gone in this year. So when we look, there's a synergy there for us. So if I start first off at the employer gets a $50,000 tax deduction. If it's an individual, so we get trust distributions, and then we're going to make a tax deductible contribution of it. You've got to be really careful, guys, if you're using this, to make sure you're doing your distributions and everything before 30 June, making sure you do it before 30 June to at least carry it forward. So you need to show there's a distribution using your trust distribution minutes and then making that carry forward. And I'll talk about it a little bit later. We may not have the cash, but what we can do is effectively we can use a promissory note, which is equivalent to cash according to the commissioner. So the 50 goes in, I get a tax deduction if it's from my family trust as employer, or I've made a distribution down myself, then I put that promissory note up into the superannuation fund. Later on, of course, I can switch that promissory note for cash from the family trust. So I've got about 3 months to do that. So what will happen is the individual or the trust gets a tax deduction. You with me on this one so far? Then what transpires is that's actually gone in, that contribution has been made. And be very careful this year because 30 June lands on a Sunday. So if you're really tied up, Saturday or Sunday, you can't get it in, you need to have a promissory note signed and accepted by the trustee of the fund. And that'll be available on the LightYear Docs system in the next 3 or 4 weeks. So what will happen, it'll go into the superannuation fund, will form part of the fund's assessable income under Section 290-160 of Income Tax Assessment Act. So that's all okay. Hopefully, if your clients have got, a lot of franking credits or tax offsets, etc., they're going to be in a good position to reduce that contributions tax bill. As I said, it's assessable, you take off deductions, whatever your tax payable is there, you might have offsets, such as a early stage innovation company, we call them ESICs. Remember, I've talked about that before. Best time to get an ESIC is right now, between now and 30 June, because whatever money you put into an ESIC, you'll get a 20% tax offset. So if I put $10,000 into an ESIC investment, which is an early stage innovation company, then I'll get a $2,000 tax offset. If I parlay that back, a $2,000 tax offset, that will actually amount to around about $12,000 or $13,000 of tax deductible contributions. So it's not a bad little thing. The reverse is if I've got franking credits, obviously that will help along that way. But the real disconnect, so we've got synergy there. So synergy between the taxpayer who's getting a deduction and synergy between the superannuation fund, which includes assessable income. Now, mind you, you're not going to have to pay tax until, we're looking at 30 June 2019, until at least March or May 2020. So that's not a bad thing. So if I have a look at that now, the big deal is the $25,000 that hits the member's account, that will be tested for their contributions caps. And as it's under 25, it's A-OK, so there's no caps at that stage. The other 25 we put up into a suspense account, their contribution suspense account. So it's flying up, but Regulation 7.082 effectively says that you have to drop it down into the member's account for who it's for within 28 days after the contribution's made. So, or such other reasonable time as the Commissioner allows. So generally it means we put it up in the suspense and then what happens, it drops down into July. So what it would mean is we've effectively escaped the contributions caps by putting it up into the suspense account. Now what happens, a bit like the farm management deposit, I'm actually doing an article at the moment on farm management deposits, and also a whole lot of, we're on a whole lot of strategies for farmers and all that's for Naomi Durden up at Port Lincoln. So I'm going through a lot of those FMDs. But essentially what will happen is next year I've got that $25,000 contribution which has to be taken into my caps. But I haven't got any deductions at that stage. So what I'm going to have to do is watch out, and I can either go through and make deductible contributions again next June and carry them forward. So again, I'm just paying the piper, or I go into excess next year. And remember, if I'm a true employee, there's going to be SGC. So I'm going to have to manage that process as we go down the track. But the contribution suspense account is a really good deal. I've just talked about deductible. Can you also use it for non-deductible? Now remember, our NCC is 100K, and then we can use a 3-year bring forward. So ostensibly I can put in 400K. Remember, this is NCC, so I'm not taking a deduction at this stage, although I want to talk about that a little bit later on. So I put in 400 June. If I put 400 in now, because we're still in May, what would happen is I could put 300 in a suspense account, but then it has to come out in 28th of June, which then means I well and truly over and above my 3-year bring forward, and I'd have $100,000 as excess non-concessional. I'd either have to pay tax or take it out of the fund, which isn't a bad deal. So what I want to do there is 100 gets booked, credited to the member's account. So accountants, you need to do that. The other 300 goes up into a suspense account for NCC. Again, you can do that easily on the LightYear docs, and it's $99 all of our docs, and so you simply go ahead and do that. So look at that strategy. Now you can see here I'm still on the 30 June strategies because I'm explaining it, I'm expanding it, I'm ballooning it out. Now let's actually go a little bit further forward. So what would happen if we took 100K as a deduction in the current year? So I put the 100K and forget about still think about the 25 cap. I'm putting 100K in as a deduction. Remember the two ways: employer contribution. Now, if you're a normal employer, if you're getting a really good bonus, you guys are on, who might be investment banks, etc., who've done really well for the year, then effectively you could salary sacrifice that bonus as long as it's allowed under the employment agreement before 30 June. Otherwise, it's generally going to be if you're in a good position this year in your family or discretionary trust, or importantly, you're your own employer and you've got some excess income. For those of you who want to look at how this works, particularly in terms of dollars, figures, exactly how it plays out tomorrow, for those I Love SMSF members, and that goes from our scholars right up to our FSAs, I've got a special 1.5 to 2-hour session where I'm going to be going through our case study. For those of you who remember our SMSF strategy day, we're going through the Smith case study, transferring family farms in, potentially doing two SMSFs, so on and so forth. So we're going to be looking at that absolutely in detail. It's taken me 3 or 4 weeks, or actually 5 weeks, to really nut it out, get those figures right. So just watch out for that one coming up. Anyway, going back to our 100K as a deduction the current year, we can put those contributions into the fund and claim 100K as a deduction, employer or personal. One thing there that we do is we've deliberately gone above the concessional cap. Now, there's been a lot of stuff around this, and you'll find out tomorrow, for those of you who get my Strategist magazine, if you're a I Love SMSF member, that there is a commissioner's ruling that where we do go above, that it's not a part for a issue, which is the main thing. Now, a lot of you freak out a little bit. It's like, well, I shouldn't go above the caps, but we're not where we were before 2013, where we had penalty taxes of 31.5% on excess concessional contributions. Effectively, what would happen on the 100K is we put it in, so it means that we're getting a deduction in our family trust. There's a reduction there from our personal income. Now, what will transpire there is that from that perspective, that 100K will go into our SMSF. It hasn't changed from what I looked at before. It will form part of the fund's assessable income, blah, blah, blah. Franking credits, ESIC would come in handy because we've got 100K. We're going to be up for 15 grand potentially in tax there. Obviously got franking credits, so we've got some good ESIC support there, or spend a bit of money on ESICs, then effectively we'll be able to ameliorate that. What will then happen is that come May or March, when you lodge the personal income tax return for the individual member and also the fund's tax return, the Commissioner will note that there's 75K of extra assessable income. So this is a whole system. In fact, there's about 30 pages, if you've ever been through it, planned to take into account contributions over the contributions threshold. And there's a whole system for that. Now, what will happen is that 75K gets added back to our individuals' income tax return. They pay tax at their marginal tax rate less a 15% tax offset. And that's a big one, less a 15% tax offset. And then there's an excess concessional contributions charge, which is determined by that excess amount of tax that is payable. And remember, we've got a 15% offset on that $75,000. We work that out, and then there's an excess concessional contributions charge. Now, what I'm going to show you tomorrow, for those who turn up, is in the case study, the way I've worked is, for example, John Smith, who was working for the family trust. He's a farmer, and farmers always work. He's 67 years of age. The family trust makes a contribution of $75,000 on his behalf. Now, mind you, the family trust is in a good taxable position. So a lot of farmers, some farmers have done poorly, but I know up at Port Lincoln, they've done really well. Some of your businesses have done really well. At $600,000 of taxable income. So both for John and also Sally Smith, who are both the grandparents or the parents of their son who's running the farm and running it through the family trust, effectively, that contributions going in, because they're already in retirement phase or in that retirement age, they're able to obviously get tax-free income, which is fantastic. It's neither assessable nor exempt income. So that's awesome. So it means that when they add back that $75,000, are you with me on that one? Because we put in $75,000, so it means that 25 fits within their threshold. There's $50,000 of excess. And again, I've worked all this one through. We find when it's added back, both the tax liability, and we've got a 15% tax offset, and the ECC comes out to $280 or thereabouts. So $280 is the total tax liability that John Smith, as a 67-year-old grandparent, will pay when the family trust makes an employer deduction on their behalf. As long as he's genuinely working, again, there's a commissioner's ruling that says, irrespective of the amount the person works, superannuation can be paid, and it's not a Part 4A event. That's gold with looking up to 30 June, because we can put in all our members. So 100K, we've got a deduction there. We could put in 400K. Now, if I put in 400K, it's exactly the same deal, but the more I put in, obviously the more tax I'm going to have to pay because I hit those higher tax rates. But again, I get a 15% tax offset. The best thing is if I've got some tax relief by way of an ESIC or a franking credit offset inside that SMSF, then, I'm really double thumbs up, triple thumbs up if I had them. But if I go up above 400K, it's still advantageous, but it drops down. Now, the only reason I'm saying that is what we can do is we can put in 100, we can get a 400K deduction, and then flip the other 300 to the next financial year. So we have to worry about our caps at that stage. So that's 30 June 2020. So it's not a bad deal. Now, what we'll have to do is, that to me is a pretty good situation for some of our clients, because we're not going to have to add our assessable income back until 2021. So have a think about that strategy. Just as an aside, for those of you, and I thank all of you for supporting, what I'm doing at the moment, because I haven't got plenty of time. I've been doing obviously lots of documents and stuff for LightYear docs. Got a huge CPD program coming up to December. What I'd like to do though is, if you really want, and I'll talk about this later on, I've been doing a lot of like half an hour or 40-minute strategy sessions with some people or some firms. So if you like to, and there's no cost, like normally if you want to hire me, I'm like $500 an hour, but there's no cost on that. So if you'd like to have a strategy session, ask me about a particular client issue or something to do with a client, or ask anything about these things, book it in with Daniel. So Daniel at ilovesmsf.com, get in and schedule it in. So until now, 30 June, I think I've got space for about 50 or 60 sessions. So you might as well be in it, and you get my ear, and I love doing that. Throw any idea or a strategy at me is the best. Anyway, we can go to 400. Now, here's the deal, which is important and is absolutely crucial. If I go over my threshold, which is 325, over 25, then anything over and above that is also an excess non-concessional contribution. So I'm just going to be careful about that to see what I've got in terms of NCCs. So employee versus personal I talked about. We can go either way, particularly if we've got a discretionary trust. Make sure you get your trust minutes in, and they'll be up and available very shortly in LightYear docs. So absolutely crucial. You need to have those up, otherwise it's assessable income to you. The trust will have to pay tax. Minors, so for children, in order to get a tax deduction, they need to show in the year in which they make the contribution, obviously if they're genuinely employed by the family trust, and particularly if you're looking at farmers, that kids will come home and work. If you're genuinely employed, you can make a contribution on their behalf. But otherwise, if they're employed elsewhere or they're in a business, then a tax-deductible contribution can be made a personal one. Now remember, that's personal. That's something that the Labor Party was going to knock out. So let's take full advantage of it. Parents, obviously we know parents, grandparents, up to age 75, we can make that. And remember, the not at this stage, but we've also got that 65 to 66 year rule where we don't have to be working. Remember, they introduced that into the May budget. Must admit, I'm going to have to get down in the weeds, wait for the legislation to come out. But grandparents up to age 75, provided you can show that they've worked for 40 hours during a 30-day period during that year. Again, have a look at the Commissioner's ruling on making payments to genuine employees either way. So it's a pretty good session. So let's move on to the next slide and have a look at some more high-value, high-revenue ideas. As I said, we've got a 30 June issue here. So with the 30 June issue, quite often our clients don't have cash. So we could do in specie, which I'll talk about shortly. But if you haven't got the cash, particularly if you need to clear out some of that taxable income from a discretionary trust or a company or wherever, or just personally, we can make a promissory note. So we haven't got that yet. That'll be out in early June, the promissory note on the LightYear docs. So you simply flip that out, give it to the trustee. The trustee will receive it and sign it. And when the trustee signs it, under the Commissioner's contributions ruling, which talks about promissory notes as being cash, then at the time that the trustee receives it, that is the time that that contribution is made. So obviously we've got a twofold. We've got the promissory note itself, and then a transfer to the trustee meeting, and having a resolution they've received that promissory note as contribution. Once that's done, whatever date that is signed and executed, effectively be the date receiving the contribution. Now we want to make sure that we've got, it's no more than really 3 months. And the reason I say that one is that from that perspective is, if it goes a bit longer than that, then it's treated as a loan, and then we have to go back to section 67A. There's no holding trust, blah, blah, blah. So we've got a problem. Transferring property in specie. So again, if you've got one, remember I said Adelaide, not sure, I'll check up on Victoria, but certainly South Australia, Western Australia, New South Wales, triple thumbs up there if that's possible, that we can transfer that commercial property, farming property, business property, offices into our self-managed super fund. If we can get away stamp duty free, and we can also get it as being part of our small business and active asset under our small business concessions, then if we've held it for 15 years, we can use the capital proceeds. The capital proceeds, effectively, there's an exclusion there. This is what I love, is around the NCC's, an exclusion for up to $1.48 million per individual. And again, this really is looked at highly in terms of the case study that I'll go through tomorrow. So certainly make sure you get on and have a look at that if you're an ILS member. The other one is that if we don't make the capital proceeds of the 15-year rule, pre-CGT can also get that exemption as well. From that perspective, then we can use a $500,000 CGT exemption. That goes in, that's excluded from NCCs. But obviously, if I'm only getting $500,000, there's still going to be NCCs there. So I need to use my strategy before of, remember, we can put some up into a suspense account if we transfer it in specie, and then we effectively can go down and manage that process again. So we go up as far as we can with our caps. We're using 2 years there, or effectively we've then got a related party loan. Gnarly dropped out, so I've done quite a few sessions on Gnarly. With that, it dropped out of the legislative parameters, but will obviously be back in now that the Morrison government has fitted there. So the good thing about the Gnarly is we don't have to go back and use Commissioner's PCG 2016/5, where, for example, he says that if it's a property, you can only get 70% LVR. You can go up to 80% because there's a number of financial institutions will do that. So as long as we can get a good letter of terms and conditions or T's and C's that someone effectively will show us, then we can cover that as a related party loan. But we've built it all together. Now, just to give you an idea, I haven't got this at this stage now, but I have built a complete document suite for a related party loan or for a transfer of business real property into an SMSF, particularly for some of those stamp duty concessional amounts, and then getting it leased back. And potentially also adding it on as being part of the segregated assets, not for tax purpose, segregated investment strategies for the purposes of a lot of these concessions, such as Western Australia and also New South Wales, not in South Australia. so that I've built a whole lot of documents. There's around about 10 documents together, but I put them all in one line. They will be available up and running probably early next year. But if you've got a client that you want to put in their business property in before 30 June, make sure you contact me at grant@ilovesmsf.com. And I'm doing a couple of other advisors, a couple of accounts, so we can make sure that we get it up and running, getting tax deductions to offset any capital gains if we don't have them. Obviously, the small business concessions are best. So make sure you get in touch with me. So transfer property in specie as best as you can, because you can use the related party loan. This would have been out if the Labor Party got in. Thank goodness they did. LRBA is on the table, so we need to get out and make sure that our clients are aware. So it's not only just us aware, we have to make sure that our clients are also aware that we've escaped the bullet or the cauldron or called out, so that if anyone wants to put in place an LRBA, then now is the time to do it. And again, there's some really good financial institutions that are poking their head up, some credit unions, etc., that will continue on to do LRBAs for properties, both residential and commercial. So make sure you look out for that. There's a couple that do farming, not that many. I know Naomi had a look around, but there are a couple that do that. And if you need some lending specialists, we've got quite a few that we can refer you to that I know have done really well. It's not a bad thing. The property market is down at the moment. One thing I do like, Morrison, again, triple thumbs up. Probably have to stop saying that, otherwise people think I'm a bit mutated into something else. But one thing I do like is the idea that instead of 20% deposit, you only need 5% deposit for first home buyers. I'm certainly going to look at that for my daughter, where the other 15% is taken up by the government through whether it's a deposit bond, etc. So I think that's good. That will give a bit of a lift to the property market. But while it's down, we're going to find some really good deals coming up down the track. Now, one thing that you may or may not have done is using an umbrella LRBA for individual shares. So much the same as we've got with an instalment warrant. I'm currently building the contract to enable individual shares. So please make sure that for those of you who want to have individual shares, I will have an instalment warrant facility that is effectively a related party loan. So you can obviously get commercial, but I'm looking at bringing that in-house if you want to do that. So that's pretty exciting, because you're obviously going to get franking credits and they'll be refundable, plus you're going to get tax deductions as well. One of the things is a year end, if you can do it, or certainly shortly thereafter. Make sure that you look at upgrading SMSF trust deeds. Have a look at, I'll do another session on a trust deed, but it's all freshly authored. You guys know me, I've been around for a long time, so I've written about 5 deeds, and this is probably the best one by far. I've covered 6-member funds, contributions to suspense accounts, sub-funds, separate investment strategy, franking credit payments, short-term trusts, blah, 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 a whole lot. And it's available on LightYear Docs for only $99. If you're one of our foundation members, so that simply means that if you're not registered, just register now on 30 June, that effectively the price drops down to $49. So a great way to pick up. I dealt with an advisor last week who's going to upgrade his 50 client funds at $400 a piece, which is 20 grand. And then I think the effective cost was around about $1,500 or $1,600 on our LightYear Docs platform. So that's not a bad way. If you need some help around why clients need to upgrade, etc., if you want to give them that communication, we've got a couple of letters there for you. But again, look, it's best to get out and make sure that you get on top of it, get those deeds upgraded. Okay, this is where this is a few little things for me in terms of standing the test of time. Actually, someone just said, as for the first 5% first home buyer, is there any limit threshold to it? Not sure yet. I think that they went out, but certainly going to have a look at that a little bit later on. But I think it's a great strategy there. Leading member SMSFs, look, I've done so many, you've heard me bang on about this. I'm not going to bang on because I'm running out of time, as is usual. But if you want to protect the lineage and the bloodline wealth for generations of your clients, then you really need to be using leading member SMSFs. To set one up, and that effectively we upgrade simply from a ordinary SMSF trustee to a leading member SMSF trustee. Effectively, there's a process there. The cost of doing that's only $99 on our platform. but the advisors and accounting firms that we've seen do that generally charge about $3,000. There is a lot of comprehensive stuff that we're going to be bringing to the table in terms of that. We've got some client interview questions where they fill out their own data collection to see whether a bloodline SMSF is for them. It's very highly suggestive in terms of whether they want to see their wealth transport and be transpired out of their family during their life and also after their life. So if we have a look at that, that's a pretty good session. I've got a few case studies. Fortunately, I've got a pop-up on Melbourne on the 11th of June and Sydney on the 13th of June. So if you can come along to those sessions, ILS members, it's $79 only. It's a 3.5-hour session. For anyone else, it's $149. Unfortunately, I'm limited to only 25 people, but that will be an absolute crackerjack session. I've got a great case studies there. I've got all the tools, SOAs, everything to show you, so that it becomes a process, a system. Everything becomes automated. So if you can get along to that, that'll be released in the next couple of days. Watch out for it, because unfortunately I'm very limited as to the people I can do. For those in Adelaide, as I said, I talked about before, commercial properties, transferring into family SMSF with stamp duty questions. We can use the deductions and the small business concessions in order to maximise our opportunities there and make sure that there's no great tax liabilities. Personal injury lawyers, look, I'm not sure if you've done any of this, but I know one area that I'd be, going back to Adelaide, New South Wales, WA, etc. I'd actually go and start targeting, looking for a list of commercial properties, particularly those people who look for agents that do commercial property management. Find out a list from there, work out with them if you can then go and send some stuff to their clients in order to look at transferring those properties into an SMSF. And then work together. I mean, I've found, and one of the greatest marketing strategies I've ever used is find someone who has got the exact types of clients that you want, and then start working with them, either in a joint venture or one other way, to make the most of it so that all parties are really happy. Same thing, personal injury lawyers. Under the rules, and I think this is amazing, is that, look, first thing is if someone has got a personal injury compensation or damages, obviously it's tough there for them and also their family. You can build that outside in the disability trust, and I've got a lot of requests for that. I will be building a disability trust probably for at least after July with all our estate planning documents. But my preference is actually put it into a self-managed super fund. Certainly if they're personally injured, the good thing about it is whatever the award is done, as long as you get it in within 90 days after the award of the damages, so this is why you need to sit and work out. You only need 3 or 4 personal injury lawyers, good ones, work with them. So when that money comes out, it goes straight into an SMSF. Now, the good thing about it is that amount, if it's paid within 90 days, effectively is excluded from the NCC rules. Now, you can put it in there. You can put it in, obviously, a pension can be created for that. When it goes in, obviously, it's completely tax-free. A pension created, obviously, we're still looking at T-bar issues around that, but effectively you can get tax-free income from that. So, again, that's particularly if they're totally and permanently disabled. So that's, again, another good business opportunity, finding those people and becoming a specialist. So inside SMSFs, we've obviously got people who do administration, but we want to get also specialists there. For those of you, I did quite a big session last week on ABPs and TRISs. You would have seen how you can get some sophisticated estate planning into our pension and TRIS strategies. As I said, in certainly the first quarter of next financial year, we'll be releasing our estate planning solutions, which will be awesome for you guys. But at the moment, certainly a good way to start it and get out to our clients is talking about dependency. If you're like me, you find that a lot of your, I shouldn't say not only your children, but sometimes your parents also are financially dependent upon you. Now, it's not guaranteed, but you'll find in the dependency declaration, if you haven't accessed it, jump on register and just drop it down. There's no cost on dependency declaration. Just use it for yourself and work out, who is your dependent? Why are they your dependent? For example, you're paying their school fees, you're paying living allowance, you're paying regular amounts to them in one way, shape or form. They'll be treated as your financial dependent. Now, it's not guaranteed at death, but as long as you've got some evidence there, at least there's a heads up for an analysis to be made as to whether the person's dependent. And of course, the beauty about being a dependent, financial dependent, is that on death, any payment made, even if they are your adult children or your brothers or sisters or parents, that effectively, such as Malik's case, when that payment's made, if it's taxable component, it's tax-free. So I want to put our hands up for dependency. Same with financial dependency, is that we can pay income streams of financial dependence, provided they're not our child and over age 18. So that we can pay to, for example, our grandchildren. And I'm going to be looking at that in absolute detail to keep farms in families for a long time when I get round to my session tomorrow when I go through the case study. So there's a lot to be looked at there. So for those who are coming along tomorrow, make sure that you bring pads and paper, because we're going to be going through a lot of stuff. From my perspective, I'm going to look at a few questions that have been raised. So if you want to raise a few questions, just use the Q&A. More than happy to blast through that. I'll be finished in a couple of minutes and then we'll go through. For me, I'm up to my ears and will be in for a long time. I spent the money that, for those of you who remember, I was at Now Infinity, and I effectively sold my stake in that, and I've basically used all that money to effectively put into LightYear Docs. And we've got an amazing, awesome platform, but it's enabled us to make sure that we've got the best quality documents at the lowest cost across Australia. As I said, it's just a flat rate of 99. But some of our family SMSF advisors on the I Love SMSF platform are only paying $20 a document. So again, some pretty good opportunities there. But if you want a quick strategy session, Daniel@ilovesmsf.com. So it's Daniel@ilovesmsf.com. Book it in. Love to have a chat with you. I love to talk and really start smashing out some ideas. For us, it's time to really engage. You've got a whole lot of existing clients, their friends and family. And look, what I found is that once we start to open up around leading members, around lineage, around bloodline, around family SMSFs, particularly we want to get that money out of those industry funds, that we start to find that there's some gold or some diamonds in our clients. And it's a good time to re-engage, because we've all faced, you think of every one of those people who were so worried about their refundable franking credits. They were motivated, they were highly engaged, and I can tell you a lot of them just as highly engaged about not passing their wealth out to their bloodline. So it's a good time to get people in and start to accelerate and take pace. Because what would happen if Labor gets in the next 3 years? We want to make sure that we don't sit on our butts and not take full chance of escaping the bullet. I mean, we're there. At some point in time, it is going to change. We've got 3 years of clear air, clear space, LRBAs, estate planning, leading members, personal injury, transferring properties in. The sky's the limit, going above our thresholds. The sky's the limit there for us. We can have some really good opportunities there. So it's time to engage with our clients and re-engage. A lot of the time, honestly, you've got so much in there, you don't even need to go outside your existing clients. You just need to engage in them, whether you're doing emails. We've got plenty of emails there for our, if you need to use, or more importantly, do seminars, or just simply send them through one of my YouTube videos if you like to do. But again, it's time to accelerate and build clients and business. You do not want to be caught in the headlines in 3 years' time if Labor does get in, because you just don't know what you don't know. Remember, hopefully Morrison's different, but Keating won the unwinnable election because Dopey, the Liberals, Houston, portrayed or put out the GST. It's exactly the same. If Morrison loses next time we're back in the Labor won't tell you, I can guarantee, they won't tell you what they're doing. It's all going to be happy and fancy and all that. But once they get in, bang, I can tell you, that's when all the LRBAs, everything's going. So make sure you get out and use it. Spend the time with the best clients and weed out the others, or let them be light touch with emails, both strategy and updates. So remember, if you're doing leading member, and make sure you come on that session, it's a great time to really make the most of things. I've got a huge CPD schedule coming up. Make sure you can go from our Scholar, which is only $49 a month, $490 a year, for all of next year, and there's at least 20-25 CPD for SEER hours there for you. So I'm touching on absolutely everything. You get an opportunity to get in touch with me. For the last thing is, as I said before, register for your foundation membership. Would be a great session. So I've got a few little questions here. So let me see how I go. So Ken, I'm going to have to check on the transferring the property in Victoria. Obviously, that's a big issue. If anyone's got some answers on that, please feel free to let me know. Certainly in Adelaide, which good old Adelaide's the home state, any commercial property is stamp duty free, which stops a lot of friction when we're doing a transfer over to SMSF. Obviously, you can use Section 62A in the stamps, and obviously in Western Australia, it's an opportunity there. But residential property, I can't transfer in Adelaide, but I can for commercial. Let me check on Victoria. Henry Zhao got a nice little question here. Question for 100K contribution over the concession limit. If, say, a member is more than pension age and also works, the trust pays 100K and claim deduction. 70K will then be added back to members' assessable income with 15% offset. So you know exactly what you're doing. My question is, even if the member has no other income and also access senior offset, super offset, how could she be liable for a few $100s for a tax bill? 75K would be at least 10K in tax. Yeah, well, if we have a look at it, the situation I had a look at yesterday was actually 75 in total rather than 100K. But where you're missing, you're quite right, Henry. So what he's saying is we're going 75K over, we're putting 100K. Exactly, you're quite right. Even with all the offsets, etc., so we're up for around about 10K tax. So I can tell Henry is a great accountant. But, and this is where the but is, so we're paying 10K in tax, which Henry has just told me. And what we're going to do is I'm just getting out my trusty calculator, my slide rule. Remember when you used to have those? And then I've got to get, Henry, I'll get 75, and I'm punching it into my calculator. You can do the same time. Multiply by 0.15. Oh, there you go. Look at that. I get on 75K deductible contribution, have a look at it in the legislation, I've got it in the strategist, at $11,250 of tax offset. So you're right, the bill might be 10K, but I've got offsets there. In fact, I think your 10K is a bit light. I think it's about 13. So on 100K, if I'm over 75, provided I've got another income, then effectively I'm probably going to be out for $2,000 or $3,000 tax. Does that make sense? The key there for you, Henry, is the fact that we've got a 15% tax offset, which is enshrined in the legislation. So I'm pretty excited about that one. Again, have a look at what we've got. Henry, again, you're keeping on, which is good. What's the difference for the trust to pay 25K for member, 75K distribution, the same member as a beneficiary? Well, there is none anymore. Under Labor, that would have been knocked out, but you can do a bit of both. But the main thing there, Henry, is timing. We need to get the distribution out before 30 June and also that contribution going in, which is the promissory note issue that I talked about before. So if I have a look at that, I've also got David Peter Lowy, thank you. So what is CGT and stamp duty consequence for, I'm presuming the property? If we're transferring a property in, then it's going to depend on where we are. If we are in, let's say I've got one at the moment, South Australia, it's a transfer of commercial property in. Effectively, there's no stamp duty there. In terms of the CGT, it was actually used, it was an active asset. So if it's an active asset, then we can use all the small business CGT concessions. If not, then what I can do is, in terms of CGT, I can use it to wipe out. Remember, the transfer over is an in-specie contribution, which is equivalent to a contribution to be deductible. Remember the one I had a look at before in the session? I could get a $400 tax deductible contribution. I just went through with Henry there, 100. Virtually, we've got virtually nothing to pay. So again, happy. You've got all these great questions. Book a session with Daniel at ilovesmsf.com. Bring it to the table, and I'm going to sit there and I'm going to smash it out with you. Philip Balding, we need to have the government reverse its policy, allow accountants to set up new super funds with the constraints of being a financial product and the 200K requirement. I agree with that one, Philip. Again, you know, from my perspective, here's the deal for me. With the what's coming up, I tell you, if Labor got in, they would have smashed us. All their policies, getting rid of negative gearing, you know, taxing family trusts, etc., was all designed to maximise the money's going to industry funds. We are on the upswing. We've got a government there for us. We need to maximise the numbers in SMSFs. And Philip, I love that. Can you please send me like just maybe some bullet points around that to grant@ilovesmsf.com, and what I'll do is I'll make sure I take it to Canberra, because I'm going to be there making sure that we look after SMSFs through the SMSF party. So let's start to put that on the table. And me, being over 50, the first thing I'm going to do is make sure those concessional thresholds, cap thresholds, are also up and running. Ian Felberg, going to cover the FCEA exam. Yep, that's up and running. So you can go start the first FCEA exam. If you go to FCEA, they've already got some practice examinations. You can go, it's 3 hours. I've had a look at a few of the queries. They look, honestly, they look pretty basic. I'm certainly going to be looking at doing some examination prep sessions with Bronnie Speed up and running. So I'll have a chat with Bronnie and we'll get out to that once we get on top of that. Let me just have a look and see if there's any on the chat line. Okay, so we've got quite a lot. Thank you very much for everyone thanks both Daniel and Ash and also Michael for covering all the questions. Look, that was a quick strategy smash out. Look, at the end of the day, please do not get into a position whereby we sit on our butts and we don't do anything. Join us, and if you want to be a foundation member, look, it costs nothing. There's no credit cards. Effectively, you're going to get you're going to get your docs for $49. It's a discretionary trust, a leading member, blah blah blah. Come along the session. Look, we're lucky. We've been in a position of effectively having capital. We're about to go out to do a small crowdfunding raise. And those of you who don't know about crowdfunding can put anywhere between 3 to 10,000. We will be an ESIC investment because of our R&D spend on LightYear docs. So that will be out in the next 3 or 4 weeks. Watch out for that. If you'd like to invest in us, we've done a great valuation because mainly we see you guys as being important to us as our supporters for all of our business to build together. So watch out for that. So if you've got an email us, support@ilovesmsf.com. Skype me, SMSF Buddha, of course, because I put on a few kilos. Look at Facebook, LinkedIn, Grant Abbott, or web ilovesmsf.com or lightyeardocs.com.au. Make sure you get on and use your dependency declaration. Here's the last point. If a client comes into you, make sure, if it's a new client, give them an NDA straight away, confidentiality. And that way they'll show you're serious, so they can't take your strategies across to another accountant, planner or advisor or a bank advisor in order to steal them from you, because we've been through a lot today. Hopefully, I'm going to see you tomorrow on our session. Anyway, thank you very much. That sigh is a sigh of relief and a sigh of opportunity. I'm so excited about what's coming ahead, and hopefully you guys will be there with me. Anyway, it's Grant Abbott signing off, and thank you very much for attending this online webinar.